I won't make accelerated biweekly payments on my mortgage because it's stealing thousands of dollars from my family. I want you to see this because this could put thousands of dollars into your retirement and more money for your family. So why do people make accelerated biweekly payments? What I'm going to do is show you guys the flaw in the thinking of this and something I call higher and better use of funds. So let's just dive straight into it. So what we're going to do is we're going to take a look at a mortgage calculator. So this is a $500,000 mortgage at 4.5% interest over 30 years. We can see the total cost of the mortgage here is pretty mind-blowing. $500,000 mortgage is costing $407,000 in interest. That's before we even get into taxes. It's like $1.4 million when we look at taxation, but that's for another video. So that's a lot of interest, and you may want to lower it. So one of the things you may consider is going accelerated biweekly. Now, this looks pretty great. You're saving $69,500 by making accelerated biweekly payments. You're paying off your mortgage 4.5 years faster, which, hey, that's pretty awesome. There's definitely a savings here. And this is what I call level one thinking. But I believe in something called highest and best use of money. So I always want to challenge you, and I challenge myself. Is there something better or smarter we can do here? Now, I would argue that most Canadian homeowners are not saving as much as they'd like to. They're not maxing TFSAs, RSPs, and getting their non-registered accounts built up. So let's consider, what if instead you take the extra money? And you may be wondering, Keaton, what are you talking about, extra money? I want to point out that accelerated biweekly does not pay your mortgage down faster because it is paying biweekly. It's paying down your mortgage faster because you are giving the bank more money every single year. And I'm going to actually show you. So here's a quick breakdown of monthly payments versus accelerated biweekly payments. Now the math is below for anyone who's wondering. What we're doing is we are paying $1,261. I'll go back just for anyone who's skeptical. So $1,261 accelerated biweekly. That's the same $500,000 mortgage. Monthly is $2,521. Accelerated biweekly is $1,261. So we're looking at $2,521 monthly versus $2,732 accelerated biweekly. Now the way I get there, $1,261 is the accelerated biweekly payment times 26 biweekly payments in the year. That comes to $32,786. If we divide that back into 12 monthly payments, converting it back to a monthly payment, we get $2,732. So when we look at this difference, we end up with $211.67 months that you're paying extra each month to have these accelerated biweekly payments. And that is where we're getting these savings from. We're prepaying our mortgage essentially. But I want to challenge you here, and this will make a massive impact. What if instead we take this $211.67 and we invest it? Now, to be fair, I made a couple assumptions. I reduced this investing to 25.7 years, which is the shortened amortization. So what we're looking at here is, what if for the period of the mortgage, person A makes accelerated biweekly payments. Person B takes the monthly payments and takes the difference, the lower amount. They're essentially paying $211 less. Well, what if they invest this at 10%, which is what the S&P 500's index has averaged over the last 50 years roughly? And you can use a lower number if you want. This is just a representation. But if they invest this money, they end up at $267,000. Now, if we really want to be smart and we're not maxing our TFSA, we put that 211 in the TFSA, so this is tax-free. So let me ask you, would you rather have $267,000, or would you rather pay $69,000 left on your mortgage? I know what I would personally choose for my family. You need to choose for yourself. If for anyone who's skeptical is like, yeah, it's bullshit, nobody's earning 10%. Okay, let's use 7. $169,000. For you naysayers, would you rather have $169,000, or would you rather have $69,000? Yeah, Keaton, that's bullshit. Nobody's earning 7%. Okay, 5.5%. I don't know when I'm going to break this, but okay, 5.5% market returns. Would you rather have 136,000? I'm not going to beat a dead horse anymore. But for those of you that want to see a bonus of how we can make this even better, we can adjust this. What if you let the mortgage ride for 30 years? Because I'm assuming that you pull the money out of your TFSA, you pay off the remaining mortgage balance. But if we were to take that $211 a month and invest it in our TFSA just every single month, and in this case, we're earning 10%, we end up with $416,000. Now, to be fair, the person making the accelerated biweekly payments may say, hey, I'm mortgage free after 25 years and 7 months, which means I have 4.5 years where I can essentially invest this 2732. So let's just be fair. Let's pull up this compound interest calculator. And let's say, okay, so let's remember this number. I'm gonna write this down, 416,498 versus, let's say someone's gonna earn the 10%. They're gonna do the full mortgage payment, which is 2732. And they're going to do it for the 4.5 years that they're mortgage free, to be fair, because the second scenario is investing. So we end up with $175,000. Now let's see how these compare. So I want you to remember first and foremost that both these scenarios, A and B, you've paid the same amount overall. In scenario B, you've paid $2732 on your mortgage for 25.5 years, and then you've basically power invested $2732 for the remaining 4.5 years. We end up with this return. In the second scenario, you've paid $25.21 a month, so a lower amount for 30 years, and you've invested the $211 per month that entire time. Now, what we can see here is that at least at 10% returns, you end up with a substantially better return by a small amount being invested over a long period of time. Whereas in the second scenario, where you pay off the debt as fast as possible, and then you invest a bigger amount for a smaller period of time, you end up far less due to the kind of compounding relationship of money and time. So some may challenge this and say, hey, at 5% or 4%, whatever it is, this doesn't work. And that is absolutely true. If interest rates go high enough for a long period of time, or market returns are low enough, there's a point where these two numbers will be equal. And if that continues to get worse, then there are many scenarios where B could be better than A. So the scenario of getting debt-free first could be better if, let's say, rates average 7.5%, 8%, and market returns average 6% or something. So there will be a bunch of break-even specific to your mortgage and the rate you can save, but just something I wanted to discuss. The other thing I want to quickly touch on is the idea of level 1, 2, and 3 thinking. Now, level 3 thinking is not inherently better than level 1. It's just more complex, and we're optimizing things more. The best way to look at this is that level 1 thinking is the lowest risk, lowest reward. It is get debt-free sooner. It is invest once you're debt-free. Level 2 thinking is like lower payments, get more money invested each month. And then level 3 is the most complex, which would be pay down the non-tax deductible debt, reborrow in a tax deductible way, then invest, creating more money invested sooner, lowering the cost of your mortgage and tax deductions. So it's important to know that these types of thinking are not, level 1's not better for everybody, nor is level 3. It depends on what you need. If you're already in a very good position and you want to lower your risk more, then absolutely just pay off the debt sooner. Whereas if the future is not something that you're happy with, it's not going to be enough, that's when you start to look into the more complex lines of thought, where you will ultimately, you'll take on a little bit more risk, or maybe a lot more risk in the case of the Smith maneuver, and you will get a bigger return if things go well. So just something to consider. The goal of this is not to convince you that you should max your mortgage payments and pay as little as possible. That's the first half of what you may want to consider. The second half is if you lower your payments and you have more cash flow, what do you do with that extra money? If you invest it, you use it to pay off high interest debt. If you start a business, you could do something very powerful for your family. And that's what I want you to take away from this. And I want you to understand the concept of higher and better use of money and kind of the levels of thinking. So higher and better use of money, simply put, I think that you should always consider what is the most effective use of your dollars. As an example, paying down your mortgage faster, saving interest, while ignoring credit card interest at say 10, 11, 12%. Well, obviously that's not the highest and best use of your money. You should go pay that 10, 11% on the credit card. Another example would be if you can invest and earn 7, 8, 9%. That is a higher and better use of your money than paying down your mortgage at 4.5% interest, let's say. So that's the first piece. The second thing I want you to consider is what I call like the levels of thinking. So level 1 thinking is, hey, if I make accelerated biweekly payments, I will pay less interest on my mortgage. Therefore, that is good. Now, that is true as a level 1 line of thinking. It is a good thing to do. But you should always ask yourself, is there something better you can do with your money? And that's where I go through kind of the levels of thinking. What I've shown you, the lowering your payments and investing the difference, that's what I call level 2 thinking. It's a step beyond. But there is a third level you can get to, which is like advanced tax strategies like cash damming, the Smith maneuver, where the Smith maneuver is an example. You pay down the mortgage on your property, eliminating non-tax deductible debt. You then reborrow that money back in a tax deductible way and invest it. Now, this does a few things for you. It allows you to lower the cost of your mortgage because let's say you do with $10,000. You're eliminating $10,000 of debt. You do not get to write the interest off. And what I mean by that is you earn your money, the CRA takes a chunk, then you pay the interest. So we pay that down. We eliminate that expensive debt that is non-tax deductible. We then reborrow it in a tax deductible way, which means that we earn our money, the CRA takes a piece of it, we pay the interest on this tax deductible debt, and the CRA gives us back the interest we pay on the tax deductible debt times our marginal tax rate. So theoretically, up to 50% of the interest we pay back. So not only have we lowered the cost of that debt, but we've also created $10,000 of investments where if those investments are primarily capital gain focused, we realize taxes for the growth of the investment sometime in the distant future, hopefully when we're retiring or we're at a lower tax bracket, and a capital gain is more tax efficient. So when we earn money in the form of capital gains, half of the gain is taxed at our marginal tax rate. It's added to our income. So theoretically, at a max tax bracket, the interest is, we're getting 50% of the interest back, whatever our cost of borrowing is. But if we were to even realize that capital gain that year, we're only paying 25% of the gain in taxes because it's a capital gain. So if you have any questions on this, please feel free to reach out. Disclaimer, this is not tax or investment advice. This is something I work with regularly and I can connect you with exceptional professionals. But I am passionate about this stuff and I wanted to share it with you because I find it very interesting for planning for my own family. And I hope at the very least, this helps you ask better, more informed questions of whoever's giving you advice. If you have any questions, just reach out or give a comment below. Cheers.